Financing your car personally is costing you over $4,000 a year. Rich people never do it. They use business credit instead and write off the entire vehicle. Here's the exact loophole they're exploiting and how you can too. Let me paint you a picture that might sting a little. Two people walk into a dealership. Same car. Same price. Same monthly payment. One leaves paying 40% more over the life of that loan and they have no idea. The difference isn't credit score or negotiation skills. It's one simple decision made before they even stepped foot on the lot. The wealthy buyer structured the purchase through a business entity. The broke buyer financed personally using after-tax dollars. That single choice creates a gap of thousands of dollars every year. And here's what makes this infuriating. This isn't some obscure loophole buried in tax code. CPAs have been recommending this to wealthy clients for decades. But somehow this knowledge never trickles down to regular people making regular purchases. By the end of this video you'll understand exactly how this works and whether you can legally use it yourself. Here's the fundamental problem with personal car financing that nobody explains. When you finance a car personally, you're paying with money that's already been taxed. Let's say you earn $60,000 a year. After federal and state taxes, maybe you keep $45,000. That $500 car payment comes from your taxed income. Now watch what happens with business financing. That same $500 payment becomes a business expense. It reduces your taxable income before the government takes their cut. If you're in the 24% tax bracket, that payment effectively costs you $380. Multiply that difference by 12 months by 5 years. You're looking at over $7,000 in savings on a mid-range vehicle. And that's before we even talk about depreciation deductions in Section 179. The math isn't complicated. But the financial industry has zero incentive to educate you because they profit either way. If you're finding this valuable, hit that like button because this is information that should be free. But here's where it gets interesting. The IRS doesn't just allow vehicle deductions. They actually encourage them through specific tax incentives. And I need you to understand this because it completely flips the script on how wealthy people think about cars. Most people see a car as a depreciating liability. The rich see it as a depreciating tax advantage. Section 179 of the tax code lets businesses deduct the full purchase price of qualifying vehicles in the year of purchase. For 2024, that limit is $28,900 for SUVs and certain trucks. Buy a $50,000 vehicle for your business and you can potentially write off over half its value immediately. Pause 2s, now combine that with bonus depreciation and you can potentially deduct even more in year 1. This is how business owners drive brand new luxury vehicles while paying a fraction of what you pay for a Honda Civic. The vehicle itself becomes a tool for reducing taxes. Not just transportation. Now you might be thinking this sounds great, but I don't own a business. Here's what the wealthy understand that changes everything. In America, starting a business is easier than getting a library card. A single-member LLC can be formed in most states for under $200. And here's the kicker. You probably already have activities that qualify as business income. Do you drive for Uber or Lyft? Business. Sell anything on eBay or Etsy? Business. Do freelance work on the side? Business. Rent out a room on Airbnb? Business. The IRS doesn't require your business to be your primary income. It just needs to be a legitimate profit-seeking activity. Even if you only make a few $1,000s a year from side work, you've established a business with potential vehicle deductions. Pause 1s, the key word is legitimate. You can't just create a fake business to write off your personal car. But if you genuinely use the vehicle for business purposes, even partially, you're in the game. And partial use is where it gets really powerful. But that's not even the best part. Pause 2s, what I'm about to show you is how wealthy people combine multiple strategies to virtually eliminate their vehicle costs. It's called strategic stacking, and once you see it, you'll understand why rich people genuinely laugh at the thought of personal car financing. Let's say you start a consulting business on the side making $20,000 a year. You purchase a qualifying SUV for $55,000 through your business using business credit. Year 1 you take the Section 179 deduction of $28,900. You also claim bonus depreciation on the remaining amount. Your business shows a loss on paper which offsets other income. Meanwhile, you're building business credit separately from your personal credit. The vehicle appreciates your business profile for future financing. And every mile you drive for business is an additional deduction. We're talking potentially $40,000 to $50,000 in tax benefits on a $55,000 vehicle. Subscribe now if you want to see exactly how the numbers break down, because this next part gets specific. Now let me show you the exact documentation you need, because this is where 90% of people mess up and trigger audits. The IRS has very specific requirements for vehicle deductions, and ignoring them is how people get burned. First, you need a mileage log. Every business trip documented with date, destination, purpose, and miles driven. Apps like MileIQ make this automatic. Second, you need to establish business use percentage. If you use the vehicle 50% for business, you can only deduct 50% of expenses. Third, keep all receipts. Fuel, maintenance, insurance, registration. Everything related to that vehicle. Fourth, document the purchase itself. Show that business funds or business credit was used. Fifth, keep a clear separation between business and personal finances. Separate bank accounts and credit cards are essential. Miss any of these and the IRS can disallow your entire deduction and hit you with penalties. But follow them precisely and you're bulletproof. Drop a comment below if you want me to create a detailed documentation checklist. Let me give you a real example that brings this all together. Sarah is a marketing consultant who also sells vintage items online. Her combined side income is about $35,000 per year. She formed an LLC for $300 and opened a business bank account. She purchased a 3-year-old Toyota Highlander for $32,000 through business financing. Her business use percentage is 65% based on her documented mileage. In year 1, she deducted approximately $20,000 in vehicle expenses between depreciation and operating costs. That $20,000 deduction at her 22% tax bracket saved her $4,400 in actual taxes. Over a 5-year ownership period, her total tax savings will exceed $15,000. Her effective cost for a $32,000 vehicle is under $17,000. Meanwhile, her neighbor who earns similar income financed the exact same vehicle personally and will pay the full $32,000 plus interest with 0 deductions. Same car. Same income. $15,000 difference. That's not theory. That's math. Now here's what most people get wrong about vehicle weight. The IRS has something called the SUV loophole, and it's been around since 2003. Vehicles over 6,000 pounds gross vehicle weight rating qualify for higher Section 179 deductions. That's why you see so many business owners driving luxury SUVs like Range Rovers, Escalades, and G-Wagons. These aren't just status symbols. They're strategic tax vehicles. The Mercedes G-Wagon, for example, weighs over 6,000 pounds and can qualify for deductions exceeding $80,000 in some cases. Now, I'm not telling you to go buy a $100,000 SUV. The point is understanding why wealthy business owners make these specific choices. They're not being frivolous. They're being strategic. Every financial decision is calculated to maximize tax efficiency. Once you start thinking this way, you begin seeing opportunities everywhere that other people completely miss. Let's talk about the business credit angle, because this is another wealth building layer most people ignore. When you finance a vehicle through business credit, you're building a separate credit profile for your business. This matters enormously for future opportunities. Personal credit and business credit are tracked separately. Your business can build credit history through vehicle payments without affecting your personal debt-to-income ratio. Over time, this business credit profile unlocks better financing terms, higher credit limits, and access to business loans that would never be available to you personally. The wealthy understand that business credit is a tool for leverage. They're not just buying a car. They're establishing creditworthiness for their next investment property, equipment purchase, or business expansion. One vehicle purchase properly structured plants seeds for wealth building moves years down the road. This compound effect is something financial advisors rarely explain to regular clients. Here are the 3 biggest mistakes that get people audited or disqualified. Mistake number 1 is claiming 100% business use when you clearly use the vehicle personally. The IRS knows your kids don't have business meetings at soccer practice. Be honest about your percentage or you'll lose everything. Mistake number 2 is failing to maintain contemporaneous records. That means documenting trips as they happen, not trying to recreate a mileage log at tax time. The IRS specifically looks for fabricated records and they're surprisingly good at spotting them. Mistake number 3 is mixing business and personal expenses in the same accounts. When your business pays for personal items and your personal accounts pay for business items, you've created a documentation nightmare that auditors love to unravel. Keep everything separate. These 3 mistakes account for over 80% of disallowed vehicle deductions. Avoid them and you're already ahead of most small business owners. So here's your action plan starting today. Step 1: Evaluate your current situation. Do you have any side income that qualifies as business activity? Even a few $1,000s annually opens the door. Step 2: Consult a CPA before making any major purchases. A one-time consultation costing $200 can save you thousands in properly structured deductions. Step 3: If appropriate, form an LLC and establish business banking. This foundation enables everything else we discussed. Step 4: When you're ready to purchase or lease, consider business financing through your LLC. Compare rates and terms against personal financing options. Step 5: Implement bulletproof documentation systems from day 1. Mileage tracking apps, separate accounts, organized receipts. Step 6: Review your strategy annually with your tax professional as deduction limits and rules change. This isn't about gaming the system. It's about understanding the system that wealthy people have used legally for decades.